In 1971, roughly 6 out of every 10 Americans lived in a middle-income household. Today, that number is closer to 5 out of 10. At first, that sounds like a simple story. The American middle class is disappearing. People are getting poorer. But that's not actually what the data says, because some of the people who left the middle class moved down. Others moved up. The middle didn't simply collapse. It started to stretch apart. One group moved toward higher incomes and greater wealth. Another became more financially vulnerable. And the distance between those two groups became harder to cross. So who is actually winning? Who is losing? And why can owning a house or a stock portfolio completely change your financial future compared with someone who relies almost entirely on a paycheck? Let's look at what is really happening. First, we need to define what we're talking about. When we say middle class, we're talking about income, not a fixed social identity. Pew Research Center defines middle-income households as those earning between roughly 2/3 and twice the national median household income, adjusted for household size. Using that definition, in 1971, about 61% of Americans lived in middle-income households. By 2023, that figure had fallen to 51%. But look at what happened to everyone else. The share of Americans in lower-income households increased from 27% to 30%. But the share in upper-income households nearly doubled, from 11% to 19%. That changes the story. The shrinking middle class isn't simply a story about Americans becoming poorer. A significant portion of the shift happened because some households moved up the income ladder. Pew describes this as a form of economic polarization. And here's something even more interesting. The median income of middle-income households is actually higher today, after adjusting for inflation, than it was decades ago. But upper-income households have pulled away much faster. From 1970 to 2022, the median income of middle-income households increased by roughly 60%. For upper-income households, it increased by about 78%. And the share of total household income going to the middle class has also changed dramatically. In 1970, middle-income households received about 62% of total U.S. household income. By 2022, that had fallen to around 43%. Meanwhile, the upper-income group increased from about 29% to 48%. That's a massive shift. But it raises a much more important question. If the economy is still growing, if incomes are still rising, and if more people are reaching higher income brackets, why do so many people still feel like they're falling behind? The answer has less to do with income and much more to do with wealth. Imagine two people receiving the exact same 5% raise. Person A uses most of that extra money to pay for rent, food, insurance, transportation, and debt. Person B gets the same raise, but Person B already owns a house and owns stocks. Now imagine that home prices and the stock market rise significantly. Person B doesn't just earn more from their job, their assets become more valuable too. That's the difference between income and wealth. Income is money flowing into your life. Wealth is what you own, and wealth can grow even while you're asleep. Over the past several decades, those two things have created very different financial trajectories. According to the Federal Reserve's distributional financial accounts, in the first quarter of 2026, the bottom 50% of U.S. households held roughly 4.3% of total household wealth. The top 10% held the overwhelming majority of the rest, and the top 1% alone held roughly 25% of total household wealth. But what's even more important is the type of wealth they own. Look at stocks and mutual funds. In early 2026, the top 1% owned more than $27 trillion in corporate equities and mutual fund shares. The bottom 50% owned roughly $590 billion. That's an enormous difference, and it creates a very simple effect. When the stock market rises, people who own a lot of stocks get richer. When real estate rises, people who own real estate gain wealth. But if most of your financial resources come from your next paycheck, you don't participate in that growth in the same way. That's why two people can look at the exact same economy and see completely different realities. One person looks at the stock market and says, "The economy is doing great." Another looks at their bank account and says, "Then why don't I feel better off?" Both can be right, because economic growth and wealth distribution are not the same thing. And this is where the story gets even more interesting. For much of the post-war period, worker productivity and compensation in the United States increased relatively closely together. In simple terms, workers became more productive, the economy produced more value, and worker compensation rose along with it. But beginning around the late 1970s, those two lines began to separate. According to the Economic Policy Institute's Productivity Pay Tracker, between 1979 and 2025, U.S. productivity increased by approximately 92.4%. Hourly compensation for production and non-supervisory workers increased by about 33.6%. That's a huge difference. Now, this doesn't mean American workers stopped receiving raises. They didn't. And it doesn't mean every dollar of the difference simply went into the pockets of CEOs. The reality is much more complicated. Technology changed. Globalization changed. Labor bargaining power changed. Markets became more concentrated in some industries. Corporate structures changed. And economists continue to debate exactly how much each factor contributed. But one fact is difficult to ignore. Productivity and typical worker compensation have diverged dramatically since the late 1970s, and that creates a fundamental problem. If your primary asset is your ability to work, your income depends on selling your time. But if someone else owns assets that rise in value as the economy grows, they can accumulate wealth without working additional hours. That changes the question. It's no longer just, how much do you earn? It's also, how much do you own? Now let's look at the most important asset for millions of American families: their home. For decades, homeownership wasn't just about having somewhere to live, it was also one of the most important ways ordinary households accumulated wealth. You make mortgage payments. Your debt gradually falls. And if the value of the house rises, your net worth rises with it. That creates a huge advantage for people who entered the housing market early. But younger generations face a very different equation. In many parts of the country, home prices have risen faster than household incomes. Mortgage rates can turn an already expensive house into an enormous monthly payment. And there's another problem. You need money to enter the market before the asset can start working for you. That's the cycle. Without enough savings, it's harder to make a down payment. Without buying a home, you don't participate in home price appreciation. Without appreciating assets, you're more dependent on your paycheck. And as asset prices rise, the initial gap becomes harder to overcome. That's why two people earning the same salary can have completely different financial lives. One bought a house 15 years ago. The other is still renting. The first person may have accumulated hundreds of thousands of dollars in home equity. The second may have spent hundreds of thousands of dollars on rent, without building an equivalent ownership stake. Of course, renting isn't automatically a bad financial decision, and owning a house doesn't guarantee wealth. But in markets where housing prices have risen sharply, when you enter the market can matter almost as much as how much you earn. And that is one reason wealth inequality can become self-reinforcing. Here's the paradox. America has more wealthy people than ever. The UBS Global Wealth Report 2026 estimates that the United States added more than 440,000 new dollar millionaires in 2025. That's more than 1,200 new millionaires every day. But that doesn't mean every American is becoming wealthy at the same rate. And this is where one statistical distinction matters enormously. Average versus median. If the wealth of a relatively small group rises dramatically, the average can increase very quickly. But the median tells you what is happening to the person sitting in the middle. That's why an economy can simultaneously have a higher stock market, more millionaires, more total household wealth, and more people who feel like buying a house, raising children, saving for retirement, or building financial security has become harder. Those things aren't contradictory. They can happen at the same time. Because economic growth doesn't automatically mean equal access to wealth creation. So, is the American middle class actually disappearing? The honest answer is yes and no. Yes, if we're talking about its share of the population. In 1971, 61% of Americans lived in middle-income households. By 2023, that figure was 51%. That's a real decline. But no, if we interpret that as meaning everyone leaving the middle class became poorer, that's simply not true. The upper income share rose from 11% to 19%. The lower income share also increased from 27% to 30%. So the bigger story isn't everyone is moving down. It's the middle is getting smaller while the distance between the two ends is getting larger. And perhaps the most important question isn't why the middle class is shrinking. It's why moving up has become increasingly dependent on owning assets. If you own stocks, you benefit when the market rises. If you own a house, you can benefit when property values rise. If you own a business, you can benefit from economic growth. But if your largest financial asset is simply your ability to work, then you have to keep selling your time to generate income. That's the fundamental difference between income and wealth. And maybe that's the question we should really be asking. Not, is the American middle class disappearing? But, where are you standing in this economic split? Are you earning income? Or are you building wealth? Are you depending entirely on your paycheck? Or are you gradually acquiring assets that can grow alongside the economy? Because over the past 50 years, one thing has become increasingly clear. Working hard still matters. But working hard is no longer the entire formula. If assets grow faster than wages, then people who already own assets have an advantage that someone living primarily on a paycheck may struggle to overcome. And that may be why two people can both work 40 hours a week and reach their 50s with completely different financial lives. America isn't simply losing its middle class. America is changing what it means to be middle class. And the final question is, which side of that divide will you be on? Tell me in the comments, do you think the next generation will have an easier or harder time becoming middle class? And if you want to understand the system behind all of this, the next video asks an even bigger question. Who actually controls the price of money?